I'm Mark Silverthorn. I hope you enjoyed this video. Today's video is titled, Can You Get Out of Debt with a CHIP Reverse Mortgage? For some older Canadians, the silver bullet for eliminating their debt might involve a CHIP reverse mortgage. CHIP is an acronym for Canadian Home Ownership Income Plan. It is a mortgage where the borrower does not have to make any payments on the mortgage. CHIP reverse mortgages available to Canadians are superior to reverse mortgages offered in the United States, where reverse mortgages do not have a good reputation. A CHIP reverse mortgage allows Canadian homeowners aged 55 years of age or older to tap into the equity in their home to raise tax-free cash. These monies are then available to pay off debts or for any other purposes. Canadian homeowners who are a minimum of 55 years of age are eligible to obtain a CHIP reverse mortgage. If you have a spouse, then you both must be 55 years of age to be eligible for a CHIP reverse mortgage. Not everyone who is eligible to obtain a CHIP reverse mortgage is going to be able to qualify for a CHIP reverse mortgage with a particular lender. In determining whether or not you qualify for a CHIP reverse mortgage, a lender is going to consider the following factors. Number 1, the age of you and your spouse. Number 2, the geographic location of your home. Number 3, the type of home that you own. Detached, semi-detached, townhouse, etc. Number 4, the appraised value of your home. Number 5, the amount of equity that you have in your home. Number 6, the physical condition of your property. Under a CHIP reverse mortgage, you may be able to borrow as much as 55% of your equity in the home. A homeowner's age is a key variable in determining what percentage of the homeowner's equity can be borrowed. The older the homeowner, the greater the percentage of equity that can be borrowed under a CHIP reverse mortgage. Conversely, the younger the homeowner, the smaller the percentage of equity that can be borrowed under a CHIP reverse mortgage. You may be asking yourself, how does a CHIP reverse mortgage work? When you obtain a CHIP reverse mortgage, the first thing your lender is going to do is pay off any of your existing mortgages and also to pay off any secured debts, such as liens on the property. Under a CHIP reverse mortgage, the homeowner retains ownership in the property and is free to sell the property. Provided the home is not sold, the lender will not call the loan on a CHIP reverse mortgage, provided you or your surviving spouse live in the property, pay the property taxes and the insurance on the property, and maintain the property. A CHIP reverse mortgage functions like a line of credit. You can borrow a lump sum or a monthly draw or both. Interest will be charged on the amounts that are borrowed. Under a CHIP reverse mortgage, the borrower is not required to make any payments on the mortgage. The borrower is, however, permitted to make mortgage payments. Under a CHIP reverse mortgage, the lender guarantees that the homeowner will never owe more money on the mortgage than the value of the home. This includes the homeowner the homeowner's surviving spouse as well as their heirs. CHIP reverse mortgages have a number of advantages. Number one, it permits a homeowner with poor credit or limited income to borrow money. Number two, the borrower receives the monies tax-free. In contrast with some other investments, an individual might have to pay income tax if they were to receive monies arising from these investments. Number three, it allows a homeowner to take advantage of increase in real estate values without the necessity of selling their home and incurring additional costs. Number four, it allows a homeowner to live in their home longer. Number five, it does not impact an individual's government benefits, including Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement. Number six, it provides the homeowner with a pool of money that they can use to pay off their creditors. Number seven, it provides the homeowner with a pool of money that they can use for settlements. The homeowner can use the borrowed funds to fund one-time lump sum settlements with their creditors in circumstances where they make a one-time lump sum payment for significantly less than the current outstanding balance. And in the description, I've listed links to some other videos on this topic. Number eight, it is a risk-free debt relief option. Using a CHIP reverse mortgage to obtain a pool of monies to pay off debts is a risk-free debt relief option. A CHIP reverse mortgage does have some disadvantages. As a result of higher closing costs and higher interest rates, a CHIP reverse mortgage will likely be more expensive than a conventional mortgage or a home equity line of credit. Having said that, many individuals over 55 years of age may not be able to qualify for a conventional mortgage or a home equity line of credit. I am now going to compare a CHIP reverse mortgage with two other debt relief options: obtaining a home equity line of credit and making a consumer proposal. From the perspective of eliminating debt, a CHIP reverse mortgage has a number of advantages over a conventional home equity line of credit. If you were to obtain a home equity line of credit, you would be required to make monthly payments. In contrast, under a CHIP reverse mortgage, no payments are required. If you were to obtain a home equity line of credit, there is a risk that your loan would be called or not renewed. In contrast, under a CHIP reverse mortgage, provided you do not sell your home, your loan will not be called as long as you or your surviving spouse live in the property, pay the property taxes and the home insurance, and maintain the property. Under a consumer proposal, an individual will repay a percentage of what they owe to their creditors in equal monthly installments over a period not to exceed 5 years. A consumer proposal is only available to insolvent individuals. You are insolvent if your total debts are greater than your total assets. If you are not insolvent, then you are not eligible for a consumer proposal. A consumer proposal will not be attractive in three scenarios. Number one, where the homeowner has significant equity in their home. In the scenario where a homeowner owns a significant amount of equity in their home, then they will be paying a substantial amount to their creditors under a consumer proposal. Number two, when an individual cannot afford to make monthly installment payments over a period of 5 years. There are individuals who simply cannot afford to make monthly payments over a period as long as 5 years. And this may include people who have limited income. Number 3, a consumer proposal is not a risk-free debt relief option. If you make a consumer proposal and if you become more than 90 days behind in making your monthly installment payments, then your consumer proposal is automatically terminated. If a person makes a consumer proposal, then there is a risk that they will not successfully complete the consumer proposal. I trust that you have found today's video helpful. Hi, I'm Mark from Debt Coach Silverthorn, and we'd like to get your feedback in terms of what some of our future YouTube topics should be. Draw from your pain and your own experience and let us know. I mean, for example, how to stop collection calls or the top 10 tactics for protecting your assets and income from your creditors. But please let us know what kind of topics you would like us to cover in some of our upcoming YouTube videos. Thanks.